Welcome to Channel Y again. I'm your host Pankaj Monga, and with me we have Daneshvar today. Daneshvar, we were talking about you were talking about predictions about AI. So can we talk about 2024? What do you think? What will happen if you go quarter by quarter?
Sure. And it's always important to say in these things, we live in a dynamic world. Who could have imagined all the events that we've seen in the last few years, including COVID and the pandemic? So disclaimers aside, Pankaj, what I'll tell you is that we're entering a world in 2024, especially as we start. I'll break it up into two parts again, because that's Definitely. What I did to start, so let's do it that way again. The first half of the year, it will all come down to one simple variable. What are interest rates going to do? The market is ending the year with the expectation that the Federal Reserve, which everyone kind of follows in different speeds and things. So when I say the Federal Reserve, think of the Bank of Canada with a different lag and with the unique characteristics of Canada. Same thing with the European Union and Christine Lagarde. So Jerome Powell at the Federal Reserve, is he going to cut interest rates 6 times? We'll find out in January, February, and March, because the market's predicting 3 cuts in those meetings. My personal opinion, that's a lot. Because the Federal Reserve tends to operate when there's crisis, when there's issues. And this is the first time the market is following what's known as the R-star. And the R-star is the natural real interest rate. And because inflation's coming down, and nominal interest rates, that 5% is still there, the real interest rate is more and more positive, which is a bigger and bigger burden on consumers because the real cost of financing is higher. There's a lot of theory I can go into about that, but that's not the point. The point is the Federal Reserve going to cut in the first few months of the year? That will set the tone for the market. If they do, then everything should be in terms of what the market expects. That doesn't mean the market goes up. It just means that there isn't anything really to be overly negative about. I think that's a little optimistic. I think earnings in corporate America are going to be okay, and corporate Canada are going to be okay. I think resources have remained relatively high, given the underlying backdrop. So I think we'll be in a low growth, slow speed type of economy and set of markets, assuming they start cutting. That's a big question. I personally think the Fed's going to be more hawkish, more protective about their current interest rate regime than the market expects. So what do you do with that information? You stay more diversified. You have different bets in the portfolio on different things. You don't get concentrated because you don't know if industrials are going to do really well in the portfolio or healthcare, or will it be technology or financials. So you want to stay diversified in an environment where the market is directionless for the time being. And then the second half of the year will really be the economic fundamentals that take time to show up. So higher interest rates are going to have a lagged effect. We just haven't felt it because the lags have gotten longer for a million reasons that we can get into. But the second half will really be, what is the economy going to do? And I personally think the economy is going to be in a slower speed environment, and consumers are going to be in that environment as well. The reason I say that is because when you think about what's been going on, we haven't felt the full impact of interest rates, not even in Canada, and especially not in the US. In Canada, more people will be refinancing into a higher interest rate regime next year, and especially the year after that. So when that happens, someone who's on variable rate mortgages in Canada right now, they're spending 10% less. This is from Scotiabank on their conference call. 10% less than they were last year. That's a lot. That's a big conservatism. That's really deciding what you're going to have for dinner, maybe skipping breakfast. Those are difficult conversations. People who are on fixed rates have barely changed their consumption and have only dropped a few percentage points. They're only down 3, 4, 5% versus 10% plus. So the economy and higher interest rates are going to bite Canadians more. And US, it's a different story because most people have a 30-year mortgage. So high interest rates have not had the bite, but by the end of next year, we'll get a much clearer picture of how sharp the teeth of high interest rates really were. What do we do with that information? because you're thinking, well, that doesn't sound too positive. And truth is, I'm not sure, because that's 9 months away in a market environment that's very dynamic. But what do you do with that? You stay diversified, and then you look for those opportunities. So when you're more cautious about how you're spending your money, chances are you're not going on vacation, but that Dollarama store is more attractive to you than it used to be. So you trade down, you make changes in your behavior, you go closer to home in terms of your travel, you get more conservative with your shopping behavior and your decisions. So you can work with that. So you don't own companies that sell appliances. You sell companies that sell low, mid-end value experiences. So there's a lot that can be done with that information. So we just have to pivot the portfolio to where consumers are going, not where they're coming from. So that's how I really think about how 2024 is going to be a really interesting year in the markets. Not that any year is boring, but 2024 is going to be a really exciting year.
So you were saying that economics, all the people who follow the market, they are predicting 3 cuts in first quarter. What's your opinion?
I think what the Fed has historically done is a decent analogy for where the Fed is going. The Fed tends to hold interest rates the same until they see the whites of the recession, as it's known. That's the short form that they use. The whites of the recession is right in front of them. So the Federal Reserve in the financial crisis didn't cut instantly. The Federal Reserve at the start of COVID didn't cut instantly. But when they cut to zero. They cut to zero, then they started buying what's known as quantitative easing in asset purchases. I think the Fed is either going to do 0 or 10 cuts. I don't think there's an in-between. Sure, could they do 1 in last year? Could they do 2? I don't think they're doing 6. I think if they see a recession really in front of them, a deep one, and the key is to maintain financial stability, financial conditions, all the things I had said earlier, I think don't be surprised if there's 10 cuts. Don't be surprised if interest rates go to 1%. But in my mind, it's either 5% interest rates or 1% interest rates. I don't think we're staying at 3.5 or anything like that. That's quasi-dovish environment. History just hasn't proved out that way. Because we don't have a garden variety recession anymore. We don't have a garden variety boom anymore. The economy has changed a lot since the 90s and the 80s, where this mentality had taken hold. So I think basically low rates or maintaining high rates, and the economic data and the information that we'll take in the coming months is really going to decide which direction we go. But I think it's binary.
Okay. And one more question,
sure,
which everybody might like it more because of this housing. So what do you think about our Canadian housing prices? Like how it will go? Like,
I'm a new homeowner, so I say that a bit tongue in cheek. But when you think about home prices in Canada, it's really an interesting dynamic. Canada is Stockholm, Sweden, and Hong Kong and Sydney. That's closer to the dynamics in Toronto, and also Vancouver and the other major population centers in Canada. So home prices in Canada, if you were purely looking as a pure investor looking for cash flow, is very poor, historically poor. You earn a gross 3% yield in Toronto real estate, but you can earn 5% at a bank or a GIC or whatever, first home savings account, whatever it may be. So investors in Canadian real estate are making the bet on future capital appreciation. How does that happen, Pankaj? It happens because there's an imbalance in supply and demand of housing. The supply, because of the green belt, because of things, and I'm using Toronto just because we're here, but we could say this for Montreal, we could say this for Vancouver, the major population centers basically outside of Winnipeg, Calgary, Edmonton, Halifax. Take those places aside because they can sprawl more. Take the major cities where most immigration comes in. The supply of housing for the level of demand, which is new immigrants coming to the country, including permanent residences as well, because they're also buying homes. When you see almost 1 million people per year coming in, or close to that, I don't have the exact stat for next year off the top of my head, but you have close to 1 million people. You simply aren't building enough housing to house 1 million people. The starts in Toronto and including the GTA might be 30, 40, 50,000 starts for new homes. That's not enough when there's 300,000 that might be in the city, and sure, more people might go to Alberta. There's emigration out of Ontario and BC into parts of central Canada, but the sheer truth is, housing is a simple question of where are the immigration numbers going to be and where are they going to settle. And I think that supply-demand imbalance is the reason why Canadian home prices have been so bulletproof for so long. And here's a question I ask myself. As fellow homeowners, this is the things we should be thinking. Imagine if there's a recession next year, or the year after, or the year after that. The timing doesn't matter. 500,000 Canadians or 1 million Canadians no longer have work, because that's what happens in recessions. Unemployment goes up. This is the best job market that we've had in, I want to say decades, because I don't know if it's exactly in decades, but at least in the last decade, but probably decades. There's no jobs, relatively speaking. Everyone's got jobs. There's a shortage of workers across the trades and across the different professional services. What happens if 1 million Canadians are losing their job because there's a recession? What happens when a politician says, I don't want 1 million new Canadians coming into the country. I only want 100,000, or I want 0. And then homes are continuing to get built. It's going to take time, but in my mind, when you think of housing, ask yourself, what is the immigration number going to be, and where are they going to settle? Because that is the reason why a 3% yield on Toronto real estate has not changed and reset itself to a different level. Home prices in Canada are a question about immigration and basically little else. And sorry to ramble on this point because I think it's important.
It's important.
It's always on our minds,
yeah.
right? Carrying costs aren't low, rental costs aren't low. The all-in cost of housing, when you need home prices to go up by a certain rate, otherwise they're sucking in income. You need that with immigration, and you have to really ask yourself, how is that going to be over the very long term? And how much development there is going to happen in parts of the Greenbelt and things like that. There are local issues for every market, as there are for Montreal, as there are for Toronto. It always will just come back to immigration and those levels, and mortgage rates are going to have a role to play. But if you're struggling to make your mortgage payment, you're not focusing on the second cottage or the second car, things like that. You can make changes in your life. That's what we talked about with our last conversation just a few minutes ago. So higher interest rates hurt discretionary spending, as it's known. They don't affect home prices as directly outside of extreme events like the financial crisis, and I don't think that's going to happen. So always ask yourself, supply demand, how is that going to be starts-wise versus the immigration numbers in a city, and that will tell you as a reasonable starting point what home prices are going to do.
Thank you very much, Dan, for coming.
Thank you.
Gave us so much knowledge today and your perspective, and we'll request you to come again whenever you have time, so that we can do this kind of shows and we can actually give update to everybody who all are seeing that. And thank you very much for watching. We'll be back soon. Thank you.